Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In yesterday's action, we saw a very erratic trading early in the session as we printed through the lows on the futures, trading just below 3,200 for a second, and the cash trading down to 3,209 before reversing and moving higher for the balance of the session. But as we came into the end of the day, it got very sloppy and we saw some selling, but then a quick recovery to close in the mid-range of the day. So nothing really big occurred yesterday, but we are seeing a continuation of the structuring of a bottom at these levels. As I said in yesterday's video, I don't expect to see any type of major collapse. Looking at the week, nothing happened. We had testimony by Powell. The Treasury Secretary also testified. There was nothing that came out of any of this testimony that was encouraging for the markets, for the economy. It was just more of the same old rhetoric that the Fed has been pumping out there for a while. Meanwhile, the House keeps coming up with a $2.4 trillion stimulus deal that they know the Senate will not agree to. And meanwhile, the posturing and the game playing between the House and the Senate continues, while many people in the U.S. economy are going to be starving if something's not done. But we already know the game, right? As we come into the final week of September, it's going to be somewhat critical because we have an outside reversal occurring on a monthly basis. And I'll be going into this in more detail early next week. This could be a very significant high that is likely to last for multiple months, taking us into Q1 or Q2 of 2021. This is a big event, and I will be covering that as we go forward over the next several days. But as we look at the fundamentals that came out yesterday, we saw claims actually come in at 870, a little bit more than what was expected, but still staying very high. But that continuing claims number came down a little bit, not nearly enough. It needed to be under 12,200,000 to actually be bullish, and it just didn't hit the mark. We also saw new home sales come out yesterday. It was up 2.5%, but the housing is the strongest area of the economy right now due to this massive migration. Now today we'll have durable goods come out. No one really cares what those numbers are. They're expected to show a 1.5% increase, but as I've been talking about, I don't think these September metrics are going to come in anywhere near what they're expected to come in. We're going to continue to see these numbers come in and disappoint at best. I don't see any blowout numbers like we saw coming from the second quarter. I've talked about this in length over the past several weeks. The other thing that continues to occur, and I'll go through in a minute in detail, is our database is not getting any traction. In fact, we're still seeing short-term selling. The liquidation is continuing. This is as low as it gets. So if we're going to see a turnaround, this is where it's going to occur from. But it's going to take multiple weeks for it to unfold. Let's go ahead and take a look at the charts, see what they're telling us for the end of the week, and I'll talk a little bit about the setup as we come in to next week and the end of the month. As we review the WaveTech database, we're continuing to see sell signals come in on the daily models. We've seen roughly 400 sells versus 100 buys, gives us a negative ratio, almost 3 to 1. And this is just blowing out this database at the next level. As I mentioned in last night's video, this is the lowest levels that I've seen in this database. This is lower than what we saw on a short-term database on even back in 2008 and 9 when markets were at their worst. So this is a significant rollover as a lot of these trends are just broken down. As I mentioned in the opening comments, this is as bad as it gets. So this is where the database will start to recover and start to restructure some sort of bottom. But it looks like it's going to take multiple weeks to be able to restructure from a blowout like we've had right now. If we look back to March when the database got blown out, it only went to about 14–15%. So this is worse even than the March blowout. But we did see a very quick turnaround, but that was a much different situation. I don't see the markets making a big flip and rallying, having any possibility of rallying like we did back in March. We're in a much different position from a technical viewpoint, from a price viewpoint, from every element that you can come up with. You can't dream up that same kind of scenario again. But this database, it will take a while to restructure itself and start to get some traction. And I continue to throw this number out at you. The 26% level is the key level. If we stay under that for the next couple of weeks, it just tells you that we're going to be grinding out this sideways pattern, and we're not going to enter into any kind of major uptrend at this point. Just to make one other comment, it also doesn't mean that the markets are going to collapse from here, but it does suggest that there is going to be a ton of consolidation at these levels and potentially setting up a very broad trading range that's going to last for several months. Since today is Friday, we'll also be delivering on Friday night. For those of you who use the WaveTech platform, you'll be getting all the intermediate orders that come out. And I do expect to see some selling. Last week was interesting. There was only a couple percent. I do expect to see that intermediate database see some stress come into it, but it's going to be on a lot of the secondary issues. A lot of the main ETFs and mutual funds and major stocks that it has issued buy orders on, most of those will not change in this configuration. It'll be some secondary symbols that aren't really material, and we're likely to see some rotation, but it should stay above 62%. It's currently at 69% bullish. Beginning with the S&P futures, the structure on the daily chart I have been discussing over the last several days continues to unfold. It appeared that this low here was going to be the key low in this pattern. As it turns out, we got another 3-day extension, and we saw a new low in the pattern yesterday. But overall, the expectation for this pattern is that this is a large ABC pattern, which at this level here, is the A wave here. So there's ABCA, and then we're likely to see an A, B, C, and then this will be a B wave. That's going to take us well into the second or third week of October to get this formation. But it's going to be key. The low that we printed yesterday is, if it does not hold that low, we could see one more low in the pattern. But as I've mentioned, and we'll go through this in a minute, these 21-week moving average is substantial, but that 21-week moving average will be the key level in the pattern. I'll go through that when we talk about the cash market here in a minute. This structure is what is expected from this pattern. We're starting to see this bottom being structured out, and this is what I was referring to in the opening comments. As we review the S&P cash, the weekly chart shows that the 21-week moving average is at 3196, but is moving up about 20 handles per week. That's going to place it between 3209 and 3214 as we come in to next week. Interesting enough, yesterday's low print was 3209. That 21-week moving average is going to move right under here and be support. PPM2 is remaining at 0.62, which suggests there's only a 40% probability for it to close below 3209 as we come into next week. But we have seen on PPM1, we've seen the penetration of both the first and second derivative, which is the green and the cyan line, and the same thing on PPM3. This in itself tells us that there is a larger pattern that's unfolding and that we're going to start to form a broader consolidation. Illustrating what I was talking about on the futures, the same thing is likely to happen here, where we're going to see this is an A, B, and then we're going to work into this market grid range. I don't think we're going to get much above the R1, R2 levels. And this is a weekly graph, so when we get an update on Sunday night, I'll cover this in Sunday's video. But this pattern is likely to remain in this sideways range. We won't know until we get into around mid-October, this upward wave is completed, on what to expect and whether this market's going to do a further collapse or if it's going to hold some of these key levels. Most likely the green line will come into play at the 3100. Also, I've discussed this in the past, we could print down as low as the 200-day moving average. So this pattern that's likely to unfold here is going to be very choppy, but I believe we're putting in a bottom of the current sequence. We should see an ABC three-wave sequence up into at least a 50% retracement of this markets. I'll go into lots of detail on the Sunday night video. We're looking out about 4 to 6 weeks from where we are right now. We should begin to set up a bottoming pattern that will further structure out in the next couple of days. Today, we'll need to close above the R1 number, 3263. If we can close above that today, then we got a shot at moving back into the market grid. Ag grid has turned up just slightly for Friday. This little uptrend is likely to continue to emerge. And you also notice that the PPM1 is turned up, crossed back above its second derivative, and starting to move higher. The futures are illustrating with the higher prices that we're seeing right now on the futures that this PPM1 is actually dropped almost to a 0.09, which suggests that there now is about a 60% probability to rise above that 10-period moving average over the next 2 to 3 sessions. And that number right now is 33.26, but it's dropping about 12 handles a day. It's going to be around 33.09 to 33.16 is going to be that resistance number right now, but that is also going to be the pivot for that ABC to the upside. Today's close above R1, 3263 will be significant. If we can move up to R2, 3281 today, that will be very positive, and especially if we can remain above 3263. If we close below 3230 today, that would be a negative, setting up for the possibility or one more retest of that 3209 to that 3198 level, representing the 21-week moving average. Next market I'll cover is the NASDAQ futures. As I've discussed all along, is the NASDAQ has a much different profile. You're actually seeing on the futures overnight that PPM1 is penetrating through its first derivative, which is a positive sign, telling us that there's about a 60% probability that will trade up to the 11,074 level. We're currently trading 11,915. R1 is 10,977, so we've actually printed an R1 so far, but we're likely to see it move to an R2, which would be 11,072, which would also be a hit of 11,074 or the 10-day moving average. A close above that level would be quite positive, and we could see a move to an R3 on the NASDAQ, but it's definitely starting to sketch out a bottom here, and the same pattern that I talked about in the S&P, this upward ABC, is likely. And the key level is going to be yesterday's low was 10,660. And if you look at the grid from yesterday, you'll see 10,648 was S2. So basically hit an S2, and on the upside, we were able to print an R2. So we had an S2, R2 level yesterday. And as we come in today, it's possible that we've already seen the low of the night, but S1 is going to be 10,806. R1 to R2 is going to be your target range on the upside. Also coincides with the move to that 10-day moving average. Next market I'll cover is the US dollar. As I mentioned in the last couple of videos, we have been trading above the RXT number at 94.06. The last trade 94.32. If we remain above that level on the close on Friday, that will trigger an RXT sell signal suggesting at least 1 to 2 weeks of sideways to down prices. All the market action over the past several weeks has been driven by this rally in the dollar. Now, it's not a significant rally, but it's big enough. It shows the underlying sentiment. And as the dollar rallies, we've seen the market sell off, we've seen gold sell off. Right now, the equity markets and gold are almost in sync with each other the way they've been trading. It's been an interesting setup that we've seen. But the dollar closes above the 94.06 level. Look for a couple weeks of sideways. That should give us some positive flow, both for the equity markets and the gold. The final market I'll cover tonight is gold. As I've talked about in the last couple of videos, there is an underlying theme that is coming out of just about every market, especially the related markets. As I just mentioned, the equities and gold have actually been trading very similar in basic structure. We've traded down to the 21 period moving average. That was 1862. We've seen a low of 1851. We did bounce from that low number that I saw last night. So if we are able to maintain a close above the 21-week, 1862, move back toward 1940 to the 1970 areas over the next couple of days. And once we see the close today, I'll be able to target the prices on gold a little better. It's possible if we see any real dips today, we've been down to 1865, you could play off that 52 low and try a long trade here, but it's somewhat risky just because of the formation that we're seeing on the PPMs. They've all collapsed. This is not the type of configuration you're going to see a big rally come from. We could see a snapback rally toward the 10-week moving average at 1952, but that's not a sustainable rally. It's just literally a trading range that is likely to be set up. My expectations are that we will trade between the 1862 and the 1952 level, probably at least next week and maybe beyond that, depending on how it sets up on the day-to-day patterns. Taking a glance at the daily gold pattern, there is a substantial amount of resistance at the 1925 level. If we just look at the market grid on the daily, you'll see the expectations on the upside is R1 1885. We've printed down to 1865. S1 is 1868. So far we've seen an S1. Now we're moving toward that print up at the 1885 level. We could see some further strength. But as I mentioned, this is not a bullish pattern. There's maybe a very short-term scalper trade here, maybe a swing trade. There's no substantial uptrend going to come, at least at this moment. There's going to need to be multiple days more of structure in the markets before we'll be able to actually determine that there's a playable low here. Right now, it's still very risky, but we do have that 21-week moving average, that 1862 level does have a high probability that will be the support for this market. This will complete tonight's video. I want to thank everybody again for hanging out with the live streams that we did both on Tuesday and on Wednesday's live stream and watching all the videos. I'm very grateful for all the participation we get from our community. Have a great weekend, everyone. I look forward to talking to you on the video on Sunday night.